Welcome back to N.D.P News, the #1 stop for current international affairs. If you're new, please subscribe to our channel and hit the notification bell to stay up to date with our future content. Thanks for joining us. Now let's dive into the video. The global economy has always been subject to ups and downs. There are periods of growth, stability, and unfortunately recession. As of now, the United States economy is showing signs of heading towards a recession. While there are several factors at play, the root cause of the upcoming recession may likely be the collapse of the U.S. banking system. To understand the current situation, we need to look back at the events that led to the 2008 financial crisis. At the time, many U.S. banks were heavily invested in subprime mortgages, which caused a wave of defaults and foreclosures. This triggered a chain reaction that led to the collapse of several major banks, including Lehman Brothers, and caused a global economic meltdown. The U.S. government responded by bailing out the banks and injecting billions of dollars into the economy through a program called quantitative easing. The aim was to simulate the economy and prevent a deep recession, but it came at a cost. The excessive printing of money led to a devaluation of the US dollar, which has had far-reaching consequences. Fast forward to the present day, and the US economy has yet to fully recover from the 2008 financial crisis. While the country has made some progress, there are still underlying issues that need to be addressed. The COVID-19 pandemic further exposed the weaknesses in the US infrastructure and medical sector, leading to a catastrophic dependence on the printing of money and the devaluation of the US dollar. One of the major consequences of the devaluation of the US dollar is the rise of the BRICS nations. BRICS refers to Brazil, Russia, India, China, and South Africa, which are 5 emerging economies that are challenging the dominance of Western countries in the global economy. These nations have been growing rapidly and are expected to overtake the US and Europe in terms of economic power in the coming years. The US recession that is looming on the horizon is therefore more representative of how the US banks have fallen out, rather than any single major issue in the US economy. The collapse of the banking system has had a domino effect on the US economy, with one hard hit after the other. As a result, the country has been increasingly reliant on the printing of money, which has led to inflation and a devaluation of the US dollar. The consequences of a US recession will be felt far beyond the borders of the country. The global economy is interconnected, and a recession in one part of the world can have ripple effects across the entire globe. The rise of BRICS nations is just one example of how the global power structure is shifting. Navigating the next recession. Expert insights on the outlook for equities. Jake Jolly, a seasoned economist and head of investment analysis at BNY Mellon Investment Management, has presented a comprehensive analysis of 3 potential economic scenarios. In his report, Jolly sheds light on the impact of the ongoing banking crisis, the stickiness of inflation, and the trajectory of rate hikes by the Federal Reserve. Jolly and his team's analysis is informed by both subjective and objective viewpoints, along with quantitative and qualitative market analysis and historical perspectives. Their aim is to provide insights that can potentially alleviate the uncertainty surrounding the economy. Jolly notes that 2 things are evident from their analysis. Firstly, the likelihood of a recession occurring in the near future remains higher than the probability of averted crisis. Secondly, despite the volatility and setbacks, the outlook for equities post-shakeout remains relatively optimistic. Here are the 3 potential scenarios that Jolly's team has identified, along with their likelihood of occurring. Scenario 1. The credit crunch. 50% probability. This scenario envisions a situation where the Federal Reserve raises interest rates 2 to 3 more times while the banking turmoil in the United States and Europe exacerbates, resulting in significant tightening of credit conditions. As a result, the United States would plunge into a recession in the second half of 2023. Europe and the UK would feel the effects earlier. The robust labor market would erode rapidly, leading to widespread layoffs. While China's post-COVID reopening buoyed the global economy, the recession would dampen this momentum. Jolly remarks, "If the US sneezes, the world catches a cold." Scenario 2. Delayed landing. 30% probability. In this scenario, the major central banks worldwide hit the pause button on their rate hikes to address the banking crisis. The labor market remains exceptionally tight, and wage growth accelerates, contributing to the stickiness of inflation. Meanwhile, China's reopening creates inflationary pressure on core goods. As inflation surges again, central banks are compelled to increase rates even further, resulting in the United States slipping into a recession in the second half of 2024. Scenario 3. Soft landing, 20% probability. This scenario represents the most desirable and, according to Jolly, the least likely outcome. In this scenario, inflation continues to decline without much need for Federal Reserve tightening, and interest rates peak at 5%. The job market remains stable as wage growth slows alongside inflation. China's reopening generates favorable spillover effects, leading to disinflationary pressures on core goods. Jolly acknowledges that the current business cycle presents unique challenges and uncertainties. He notes that the post-COVID labor market is not behaving as expected, and there is a possibility that the economy may experience disinflation in a way that it has not in previous cycles. But what do you think of today's topic so far? Drop a comment and let us know. Now let's get back to it. The gig economy, a passing fad or a lasting trend? The gig economy has been a subject of intense debate and speculation in recent years. The rise of digital platforms and the increasing ease with which individuals can connect with potential employers and clients has given rise to a new wave of entrepreneurship and work arrangements. The COVID-19 pandemic further accelerated this trend, as many traditional businesses were forced to close their doors and workers saw alternative sources of income. However, recent data suggests that the height of the gig economy may be behind us. According to a recent note from Bank of America, the share of its customers who received income from gig-type jobs grew 3 times higher during the pandemic. However, this trend seems to be coming down now, with gig-type income slipping to 2.7% in February 2023, from a high of 3.3% in March 2022. There are several potential explanations for this decline. One possibility is that it reflects lower demand, as the economy has reopened and there is less need for restaurant takeout orders and grocery deliveries. Additionally, a shift from goods to services spending could mean less gig work at delivery and social commerce marketplace platforms. On the other hand, it could also be a supply-side issue, as strong wage growth in the service sector might have enticed gig workers into full-time jobs. Interestingly, this trend could partly explain the recent increase in the labor force participation rate for younger workers. Research shows that gig workers tend to work in the service industry, so the rotation from gig work to traditional jobs could be contributing to the increase in the labor force participation rate. The participation rate for prime-age workers, those between the ages of 25 and 54, was just over 83% in March 2023, its highest level since January 2020. While the decline of the gig economy may have implications for the labor market, it is important to note that it is unlikely to have a significant impact on the overall economy. In fact, the recent failure of First Republic Bank, which J.P. Morgan Chase bought most of the embattled regional lenders' assets, is not expected to increase the chances of a recession, according to Jamie Dimon, J.P. Morgan's CEO. Dimon stated that the banking system is very stable, and that the failure of First Republic does not change the odds of a recession. However, he did warn that the economy is not out of the woods yet, and that there are still storm clouds on the horizon, particularly with regard to rising interest rates and a potential downturn in the real estate market. We value your opinion on the current state of the U.S. economy. Do you believe a recession is imminent? Could the decline of certain U.S. banks trigger this downturn? We're also interested in your perspective on Jolly's evaluation. Please share your feedback in the comment section below, as it is highly valuable to us. Thank you for your attention. This has been N.D.P News, signing off.